The risks of higher unemployment and higher inflation appear to have risen. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment.
And we turn to our special contributor, Larry Summers of Harvard, for a reaction.
I thought the chairman handled the difficult situation correctly. Look, he has a real problem. Policy is pursuing a supply shock that we are inflicting on ourselves. We're pushing up prices with the tariffs, which is a path to inflation. In response to that, monetary policy normally hits the brakes. We're sucking purchasing power out of the economy and creating huge uncertainty that potentially is chilling spending. In response to that, monetary policy traditionally hits the accelerator. It's kind of a trick that we've pursued policies that have made expected unemployment and expected inflation go up at the same time. It's not a good thing to have done, but faced with both of those effects, not knowing which one is going to be larger, not knowing what the size of the shock is going to be, not knowing what the effects of the uncertainty is going to be, I don't see how the Fed had any viable alternative but watchful waiting.
The Fed said explicitly just exactly what you did, which is the risks of inflation have gone up and the risks of unemployment have gone up, which really goes to the dual mandates. And Chair Powell did his best to dance around that. But as a macroeconomist, if in fact you end up with inflation and higher unemployment at the same time, and you have to choose between the two mandates, does history tell us which you should choose?
So this is a rare situation that the Fed finds itself in. Look, I don't think there's a hard and fast rule. I think the balance of opinion would be among economists that the Fed first obligation is to the price stability mandate, because if you let inflation go, you're going to have higher inflation expectations, and that's going to risk higher unemployment down the road almost for sure as you try to achieve disinflation.
The one constant it seems we have right now is uncertainty. We heard about it from the Fed, we hear about it on Wall Street, we hear about it from companies as they report their earnings, uncertainty, and it pops up in all sorts of ways. What do you make of what happened with the Asian currencies in the last week? I mean, like, for example, the Taiwan dollar went up more than it had done in decades.
My instinct is that the Taiwanese situation, because of the national security aspect, because of how much the currency had been pegged, is because of aspects of the hedging behavior, is somewhat unique. So I don't think it would be right to see it as a precedent for multiple other moves that are going to take place. But I'm not certain of that. And I'm very much aware that there are huge foreign holdings of treasuries at this point, that the other side of that flow into U.S. treasuries, that what enables other countries to buy all those treasuries is the dollars they're accumulating, because in toto, they're exporting more to us than we're exporting to them. But I don't think the contradiction between hating the trade deficit and loving the capital inflows is entirely clear in the mind of the administration. I have not heard the Secretary of the Treasury thoughtfully address the question: if we scale back trade deficits, which after all is the repeated and constant emphasis of their policy, how are we going to have the capital inflows that are necessary to keep interest rates bounded, that are necessary to accumulate all of the debt that we are mounting? So my guess is that this Taiwan situation is sui generis, but it is indicative of a much broader kind of challenge that we face with capital inflows and trade deficit. The one thing we know is that we can't fully resolve that trade deficit just as a matter of arithmetic without also reducing the foreign capital inflow into the United States.
President Trump has been pressuring the Fed to cut rates, which the Fed chair, Jay Powell, has resisted. Larry's fellow Harvard economist Ken Rogoff was the chief economist at the IMF, and his new book, Our Dollar, Your Problem, looks at the link between Fed independence and the strength of the dollar. We've heard from the chair, Jay Powell. One of the concerns going into this was the independence of the Fed, given some of the remarks from the President of the United States, Donald Trump and others. Did Jay Powell help restore some of the confidence in the independence of the Fed?
Well, he's definitely held the line, and Trump has retreated at the same time. But he's just been very professional, kind of ignoring Trump and, saying the truth. Tariffs are going to cause higher prices and lower output. Trump might not want to hear it. I mean, to be fair to Trump, every president tries to get the Fed to lower interest rates, or 99% of the time. But I think where he is crossing a line is saying, well, I'm going to fire him. That's just self-destructive. He's shooting himself in the foot. I mean, that said, Fed independence is not as sacrosanct as people think. I'm amazed how many educated people I talk to who think the Fed's in the Constitution and you can't do it. It's not. It's a creature of Congress. There have been various acts of Congress, but 1913, it's when it started. If Congress were in cahoots with Trump, they could literally make it disappear in a week, bring it back under the Treasury.
We have a tendency right now to think everything is because of Donald Trump as president. As you point out in your book, the dominance of the dollar actually may have peaked like in 2015.
Exactly.
There are larger forces even than Donald Trump afoot here. What are the consequences of a relative decline in the dollar as against other currencies?
So first, the fact there are larger forces is significant because, if he backtracks and somehow convinces everybody to forget that it happened, the rule of law is fine, we're not going to arbitrarily put tariffs and this and that, we're still in a period of dollar decline. So the consequences of it are, first, we'll pay a higher interest rate. Now, we probably pay between 0.5% and 1% less than we would if we weren't so dominant. It's not just that the dollar's the most used, it's way the most used. And to be clear, that doesn't mean we're paying less than Germany, because we borrow a lot more than Germany, so it's sort of controlling for what we're borrowing. And that applies to mortgages, to car loans. It's a big deal.
So if the United States were to come together as one, just bear with me now here on a counterfactual, if we were to come together as one and came to Ken Rogoff and said, our priority is making sure the dollar does not continue its decline, what would you advise us to do?
Well, I mean, the simplest thing for short term is preserve Fed independence, which I do think is under duress in a lot of ways. Don't do the tariff war, which absolutely accelerates the process. When you restrict trade, you're putting sand in the wheels of the global financial system. When trade can't move freely, it affects finance. Since we're the kings of finance and we benefit from that, that's not a great idea either.
Coming back to Jay Powell, chairman of the Fed, and what he had to say this week. Basically, the Fed told us the risks have gone up of both inflation and unemployment. Are we headed to stagflation?
Oh, I think it's very likely. I mean, that's the base case here, that the hard numbers are not so bad. They're mixed, but not so bad. I mean, the jobs report was amazing. But, nevertheless, if you look at business confidence, consumer confidence, global confidence, and some of the more forward-looking measures, it certainly looks like if we don't quite go into recession, we're going into something that'll feel like it. And just, the arithmetic of the tariffs is it's going to raise prices. So near term, yes. Now, is that a one-time thing or not? It's not. It's hard to know what behavior will be. I mean, I think the Fed's a little bit worried that this is coming on top of what just happened, where people were told, except by Larry told you, but people were told, this is temporary, it's transitory, it's going away, one-time thing. Now the tariffs are coming. Oh, it's transitory, it's temporary, one-time thing. Well, you're not going to believe them. And wage setters, businesses. So it's a difficult period for sure for the Fed. And stagflation is the most likely outcome. And Powell kind of said that without coming out and saying it.